This conference will now be recorded.
Hello, everyone. This is Landon Jones, the founder of Revisor. I'm here with a couple of awesome, extremely smart young gentlemen by the name of Ethan Dunbar and Nick Cargill. They are both on our investment management team. Ethan is our CIO, Chief Investment Officer, CFA, wicked smart dude. And Nick's not been with the firm quite as long, works under Ethan, is working on a CFA now, and one of the most intelligent dudes I've ever met in my life. Builds his own guitars. I don't know what all this guy can do. He does everything. He's a very smart, very smart dude. Love to have him on our team. And we're gonna do our weekly update. We're gonna start with Ethan. Ethan's gonna cover economics, interest rates, things of that nature, and then Nick's gonna cover some portfolio related stuff. So Ethan, start us off, my man.
Sounds good. Thanks, Landon. Thanks for the nice introduction.
Yes, sir.
So this week, it was an interesting week last week. First, focusing a bit on the economy and the jobs report from last week. In our last call, we had been talking about the expectation that the economy is slowing down. We're potentially heading into a recession, and we got some interesting data last week in the jobs report that would indicate that some of that might not be true. I think that's just a microcosm of this weekly data, and it doesn't um, uh, you know take away from the overall thesis that we still are very likely heading into at least a slowdown, if not a full-on recession. But I want to acknowledge the numbers from last week. So last week the payroll numbers came out and were above expectations. And the unemployment numbers came out and were actually below expectations. So good job growth, low unemployment, which contradicts some of the issues that we might be expecting to see in the economy. However, remembering that this is only 1 month of data is really important. We still think that there is a downturn that's underway and potentially is already started. And when we dug into the numbers a little bit more deeply, we could see some cracks in the theory that this data from this last month completely reverses the course that we've been talking about. So, just as an example, the resolution of the United Auto Workers strikes came back into the data last week from the jobs report. There was a good amount of jobs coming back on board from the resolution of those strikes. The other thing is government and healthcare were big beneficiaries of additional jobs, and those are typically not indicative of a recessionary cycle. They're typically more recession proof. So some of that data might be misleading if you look into it a little bit more deeper. And about 80% of the payroll gains came from those three numbers, right, or from those three elements right there, both the government's healthcare sectors as a whole, and then the resolution of the United Auto Workers strike. So that was just some acknowledgement of the data last week. We still think that very likely that we head into a recession or at least a major slowdown that's kind of underway, or at least in the beginning stages of actually coming to be. But in the market, at least the interest rate market, seems to agree. So the interest rate market is actually pricing for 100 basis points of FOMC cuts in 2024. That's obviously a prediction of the market, and we could see quite a bit of volatility in that prediction over the coming 3 to 6 months, 9 months, and beyond. Um, but we'll see how that pans out. The big story in interest rates is that overall interest rates are, especially if we look at the Treasury yield curve, are down significantly from a month ago. The 10-year yield is down a little more than 40 basis points from a month ago. The 20-year and 30-year yield, Treasury yield, is down almost 50 basis points from a month ago. So those, and even the 5 and 7 year yields are down quite a bit, about 40 basis points from just almost 4 weeks ago. So that the expectation that interest rate cuts and interest rate levels will come down is being priced into the market right now. We'll see if that comes true. In order for that to come true, that's fulfilling the expectation that there is a slowdown and inflation will come down, and the Federal Reserve will end up being more accommodative to the economy and actually cutting interest rates. But again, very important to watch how these numbers, not just 1 month, but how they tell a story over a 3 to 6 month period, more than just 1 month. Because again, like we look at the jobs report, if you look at just that in a microcosm, it can be somewhat misleading. Same thing with CPI numbers. CPI numbers came out actually today and a little bit hotter than expected. And, again, that could be somewhat misleading. But overall, the story in the interest rate market is a significant drop, especially in the longer duration yields like the 20-year, 30-year, 10-year, so on and so forth. And that feeds right into equity markets. So equity market story, the breakdown in late October that we saw, the somewhat notable sell-off was seems to have come out to be kind of a falsified sell-off. We've rebounded from there. The S&P 500, if we're looking at that as our example, has kind of knifed back through its moving averages and is back knocking on the door of being kind of overbought, actually, if you look at it from a technical perspective. So equity markets kind of came back. Some of that, or actually a lot of that, makes sense if you look at the interest rate level coming down as much as it did. That makes sense. That feeds into valuations, especially some of the types of stocks that did well over the past month. Were definitely beneficiaries of that. Some of those more higher volatility stocks, some of those higher market cap stocks, that they were the beneficiaries of those lower interest rates. Also, another beneficiary of those lower interest rates is going to be those companies that are not profitable, that are needing to borrow money in order to finance their operations. The lower those the borrowing costs are, which is a direct correlation to the treasury market, or at least somewhat direct correlation to the treasury market and level of interest rates. Lower interest rate levels, lower borrowing costs, good for equity market valuations. The other thing that was interesting, I'm going to switch over to my highlight page here as I have a note here on just how important or how notable this is right now. But the other thing that's interesting is value stocks versus non-value stocks at the moment. We believe that value will be in favor going forward, especially the next 12 months or so. And some of that is coming from just value stocks are cheap compared to expensive stocks right now. If we compare those value stocks, a good way to look at this, if you just look at the S&P 500, the S&P 500 on a market cap weighted basis, obviously being market cap weighted accommodates and overweights the more expensive stocks that have higher market caps. If you look at that compared to the S&P 500 equal weight, which takes away the effect of the large companies that have large market share being more and more of a weight in the index, the S&P 500 equal weight is almost 20% lower. If you look at the PE ratio, it's about 20% cheaper. 20%, the PE ratio is about 20% lower than the S&P 500 on a market cap basis, meaning in my expectation, or in a lot of people's expectation, that there is potential there in value stocks, just with them generally being undervalued versus the more expensive stocks in the index. So again, not that the more expensive stocks that have done phenomenally over the past 12 months are bad, but I think there's a play for value coming into the market here that could be very interesting over the next 12 months. So that's my story for the week.
I like it, man. That's interesting, man. Throwing in, comparing the cap weighted versus equal weighted. That's pretty interesting stuff. That's kind of that same story of the big seven driving the S&P right on the cap weighted side, kind of seeing it from a slightly different angle.
Exactly. Yep. Exactly.
So me as a financial advisor, other advisors listening, anything I should do with this information? Like most of us are using firms like Revisor, building out that are handling the details of portfolios for us. Is this more of I feel like I need this kind of information to stay up to date to be able to conversate and know more than my client base when they come in for reviews and whatnot. So outside of me, let's say needing this information so I can have great conversations with the client base and be informed, anything else I should do with this information, or am I going to let y'all do the doing? Y'all can do it.
Yeah, that's the main part is certainly explaining, well, what's going on in the portfolios, and especially right now, like we just released our video covering some of the rebalances in the low volatility portfolio. The low volatility portfolio has a lot of these top market cap companies. Again, one of the goals being to limit the deviation from the market cap weighted indices. So we have a good portion of those companies in there, and they were overweight. So we're rebalancing them back into the portfolio, trying to bring their weights down to basically sell off some of those companies that have done very well, and then reallocate to some of the other companies that maybe are cheaper right now. And that is an explanation of or connects really what's happening, or we're talking about here, which was with what is happening in the portfolios. So, like you said, Landon, explaining the trades and justifying the connection between the analysis we're making here and the actual trades that get implemented in the portfolio is the big thing, and that's the biggest example right now the last couple of weeks.
For sure. Awesome. Awesome stuff, man. Well, appreciate it, Ethan. Let's move over to Nick. I know, Nick, you've got some specific revisor portfolio related things to cover. So the floor is yours.
Yeah, sounds good. Going ahead, get this sharing. All right, am I coming through?
You sure are. It looks good. Oh no, it just went away.
Oh,
It was there.
oh, okay. Hold on, I was double checking that I was coming through, so that's why. Let me get it back up. Beginning. Let's see here. So many tabs open.
There it comes.
All right, there we go. So yeah, thanks, and thanks for the generous introduction earlier.
Yes,
We'll
indeed.
start off with low volatility, the one that Ethan was talking about. Um, Overall, we had a pretty good week for the low volatility sleeve. Feeds into what Ethan was talking about. We have those larger companies that have done well. Specifically, larger tends to be more of a blend, so it's got some good growth exposure. Growth performed well last week, so we had a good return. Our large cap returned somewhere around 0.56% for the week. S&P 500 total return was around 0.24. So we were definitely excited with that. Some significant outperformance with the mid cap, a little bit of underperformance with the small. Definitely going to be an interesting one to watch in the future, just with the blend and compared to some of our more value-oriented portfolios that we're going to look at here in just a second. So that takes us to the Dividend Aristocrat. Definitely going to be more of a value-oriented portfolio, focusing on increasing dividends. Return negative 0.39% for the week, feeding into that narrative that we discussed. Growth did well the prior week. A little bit below the S&P 500 Dividend Aristocrat total return. So keep an eye on that one as that value shift that we think is going to come plays out over the coming year. Similar story for actively passive. This is more of a strategic, tactical portfolio that we do. We weight things differently based on the current narrative in the market and how we think things are going to perform. At the moment, it's pretty heavily in value, again, since we see that performing well in the coming months. returned negative 0.23%, in keeping with that more value-oriented index that we have in our indexes here down at the bottom. Another one to keep our eye on. And that finally takes us to the defensive series. This one explicitly seeks out low volatility or low beta stocks. So the opposite of those high volatility stocks that have appreciated a good amount in very recent times. So negative return for the week, a little bit less than the dividend aristocrat and the actively passive. Did beat that value oriented index where you returned negative 0.18% for the week. Definitely another one to keep an eye on. The small cap, on the other hand, did perform pretty well. We were up 1.06%. Index was up 1%. So another one to keep an eye on. I think the big takeaway this week, though, or at least the thing that I thought was most interesting, came from the fixed income side of things. So you can see running throughout all of these portfolios, this is our fixed income moderate portfolio. This goes back to that yield story that Ethan was talking about. So you can see here we were down 0.06% for the week, so pretty much flat. The Bloomberg aggregate was up 0.15%. And this is largely because it's a bit more of an aggressive portfolio. They have more duration in their holdings at the moment. Again, we reweight our moderate and conservative and aggressive fixed income portfolios, for that matter, in keeping with what we expect from the market. So at the moment, we have a lower duration than the Bloomberg Ag. And so we experienced more of a decline this week. That's interesting because short-term bonds actually took the biggest hit last week, which, is counterintuitive. Usually you expect the shorter-term stuff to be a little bit more stable than the longer-term stuff.
Yeah, I don't like that.
Really,
it's messing me up, Nick. It's messing me all up.
Yeah,
it's not supposed to work that way.
It threw me for a loop for a while.
Somebody call the stock market and let them know that I don't approve. Get that fixed.
Yeah, I'll let them know. Me neither. Yeah, definitely an interesting story, but it gives us great stuff to talk about here, so I'm not complaining.
For sure.
Basically, what it comes down to is, it makes sense. Yields moved more on the shorter term and of things and moved less on the longer term. So for 2-year Treasury yields, they were up 18 basis points last week. So yields were up, prices were down. As opposed to the 10-year yields for Treasuries, they were only up 3 basis points. So we've got a pretty big disparity there in the yield move, much higher yield move for the short term, outweighing that difference in duration, I guess, that takes away some of the risk. So, long story short, short-term bonds were the big loser this week because of that yield move.
So what would you and Ethan say to, like, for layman's like myself, a lot of our audience, we have some folks that I would say are investment specialists, but a lot of our audience are advisors. They're CFPs like me. We've got some expertise in investments compared to, let's say, the public, but we're spending time in all these different domains, right? Tax work, estate work, all over the place. So when, let's say, we see most laymen's like myself are familiar with real simple concepts like interest rates go up, bond prices go down on average, right? Or interest rates go down, bond prices go up. We kind of have those little rules of thumb that we know about, and I would say understand, for the most part. But in a situation like this where we had fluctuation in bond prices for the week, but no, it doesn't. I think I could safely say not because of interest rates adjusting upward or downward, right? We didn't have a change in the Fed funds rate or anything of that nature. What would be, not that that either one of you have the answer, but if you were asked the question, what caused that change in bond price? What was the cause? If it's not interest rates, what would be the reasoning? What would be a possible thing for laymen like myself to have in their head that was the cause of that decrease in short-term bond prices?
Yeah, no, that's a great question. And actually, Ethan and I were going back and forth on that last night. I'll kind of give my thoughts, and then I'm sure Ethan will have a much better explanation of it.
Please.
But my thoughts at least, or at this point, our expectations are changing in the market. People are expecting cuts sooner. Um, so people are moving further out the curve to pick up some more duration and possibly, expose themselves to a little bit more price appreciation. So with that comes, the difference in yield. So if people are buying more bonds further out the curve, then there doesn't need to be as much of a yield incentive for them to move out there. Whereas on the shorter term, maybe there does. And so that would be my guess. Ethan, would you add anything to that?
That makes sense. It's going to be interesting to watch what happens over the next 12 months. I actually think bonds could be in favor over the next 12 months, especially more duration risky bonds. That's something that we certainly have to consider adding back duration back into the portfolio, because there's going to be a time when interest rates on the short end of the curve are no longer attractive. And there's this huge amount of money piling up in short duration instruments right now that eventually, when those instruments, they mature frequently. If you're buying bonds that mature every 6 months or 12 months, you get that money back. And we've seen this. I think everyone has seen this huge amount of flow into short-term bonds, because you can get 4%, then you got 5%, then almost 5.5%. And there's going to be, in my opinion, there has to be a kind of flip-flop at some point in the future, and snap back into going into duration, because that interest rate is the yield on the short end of the curve is just not going to be there. And that will bid up the price of those bonds on the longer duration side of the curve. The other thing that's important to remember is on the short half of the curve, big impact from what the FOMC is going to say, and how they set their interest rate, policy. The right half of the curve, the longer duration part of the curve, is more affected by trading the market and the expectations that the market has. So again, we'll see what happens over the next 6 to 12 months. But I really expect, as the interest rate level that the Federal Reserve is going to set um, potentially changes in 2024, and potentially is much less attractive to bond traders or investors, you see a bid for longer duration bonds. And I think we see that microcosm being traded week to week, right? So expectations about that get traded week to week. So you could see something like that manifest itself in a week like this. Sometimes it's hard to tell with just a week of data, but if you start looking, okay, now you have 2 weeks of data and 5 weeks of data and 6 weeks of data or 6 months of data, and you can kind of see this trend uh, uh, reveal itself. I think that's what we'll see over the next 3 to 6 months, if not longer, into 2024.
I like it, dude. I like it a lot. That brings kind of a secondary question. So for, let's say, picture our younger CFPs. I remember being embarrassed to like even ask certain questions because I thought I was supposed to understand it, at this point, at that point in my career. But like, so getting back to that, okay, we know interest rate fluctuations, historically highly correlated with bond price fluctuations, right? Is it also safe to then say, if we use that example, if all of a sudden out of the blue, the market as a whole, which are all the parties that are buying and selling stuff, right? If they decide they want to sell short-term bonds on, a sell-off in short-term bonds, let's say, occurs, and there's more money flowing into longer duration bonds. That would be another example of something that can cause price fluctuation, right? And in that particular example, we would expect to see a decrease in the value of short-term bonds and an increase in the value of longer duration bonds, if that
Yes.
type of trading activity was going on. So if you make that concise, you could say, hey, it's not just interest rates that cause bond fluctuations. You also have just normal market factors, right? Like the market wanting to sell off a certain, lower duration versus higher duration, whatever the case may be. Or the same thing can happen, right, with something like treasury inflation, tips or whatever. If for some reason the market got an itch to sell off, they were, let's say, forward looking and thought inflation was going to slow down and we start to see a sell off, um, we could very easily see a significant decrease in the average price of tips, correct? So we've got interest rate issues, we've got normal market issues. Anything else that you would throw in as a last example of another factor that can have a pretty big impact on bond prices?
Yeah, no, that's a really good assessment there, and yeah, it comes back to the element that again, the further away you get from maturity, the longer duration you have, the more the market trading is affecting the price of the bond, the ultimate yield, all of that stuff. The closer you get to maturity, the less room you have to fluctuate there because you're going to get your money, the bond is going to mature
It's
and
gonna
come
be
back to
it's gonna be there soon. Yeah.
Exactly, yeah. But the market, the expectations that the market are trading on are various, right? That's why one of the reasons we focus on some of the economic releases from the last week, inflation data, because we're the market is looking at that to assess the future level of interest rates and try to price the bonds accurately and try to take advantage of just the stuff that we were talking about there, right? If short-term interest rates are bound to go down to, if let's use an extreme example, they're bound to go down to zero again in the near future. That completely changes the market environment versus if they were going to be stable for the next 6 months. So the market's trading those type of factors on a day-to-day basis, and the bond market's very efficient, especially the
Yeah.
treasury market. So yeah, a lot of factors can affect where those bonds trade and how they trade.
Yeah, absolutely. So that you could is market factors affect bond prices. It's not just interest rates. You've got all of these other factors that can come into play that could be just as have just as big of an impact, upward or downward. That
Right.
all makes sense. Awesome. Well, anything else? Did we cover everything?
I don't have anything else.
All right. Well, that was awesome. Appreciate both of y'all taking time. I think that was great. I think that will give our advisors a nice overview and be very helpful. So thank you very much.
Awesome. Thanks, Landon.
Of
Thanks,
course.
Nick.
All right. Bye bye. Bye, Nick. Bye, Ethan.
Thank you.
Bye, everybody.